Good morning and welcome to HCR University, where our mission is to drive change through education of our clients as well as those we interact with in our industry. My name is Anthony Fioretti and I'm the Head of Benefits Operations for HCR nationally. Thank you for joining our webinar today. I want to also start by thanking our sponsors, particularly Anthem Blue Cross and Blue Shield, who is our exclusive healthcare sponsor for HCR University. These sponsors help us take HCR to the next level. So again, we thank them for their support. Today's discussion represents the beginning of a four-part series that breaks down this massive law into smaller bite-sized chunks. You'll see on the screen, we start today with the new math to help you determine which parts of the law may be applicable to you. Next month is all about reform and how it creates new opportunities in the area of wellness to reward those who stay healthy to help us drive down costs. In May, we go to all about exchanges and a whole new marketplace that you'll be either engaging in or competing with in the years ahead. And lastly, as part of our series in semester 1 of HCR University, we'll get to plan design and how to manage inside the law's requirements so you can avoid costly tax implications. We felt the series approach would allow us to go deeper on the most important issues for you, so we hope to see many of you in our audience in the months ahead. So let's get started with today's program. I'm pleased to introduce HCR's very own healthcare reform expert, Renee Kuss. As a benefits attorney with more than 15 years experience, Renee has been studying and advising our clients and teams since the law's enactment way back in 2010. So with that, I'll let Renee outline today's discussion. Take it away, Renee.
Good morning, everyone. Thanks, Anthony. Before we get started, I just want to note to you that if you look at the control panel on the right-hand side, I have a hypertext link for those of you who may want to print the presentation out for note-taking purposes. If you haven't already noticed that it's in the control panel there under the chat function, you can go ahead and take a moment to do that as well. And then also, we have quite a few callers on the call today, so all calls have been muted. What we'll be doing is asking that in the control panel on the right-hand side that you chat the questions that you have, and at the end of the presentation, we'll get through as many questions as we can. We will not call you out, so feel free to ask whatever you'd like, but we will, again, go through the questions at the end of the call, but feel free to chat them at any time so that in case you don't want to forget them at the end of the presentation. And so what you're seeing now on the screen are the four main areas we'll be talking about today for the new math of healthcare reform. And what you'll probably, I'm hoping, see is that our theme today is math. In order to figure out how healthcare reform applies to you and what you need to do, a lot of it has to boil down to the mathematics of it all. So when we get started with healthcare reform, the first thing you need to look at is, are you an applicable large employer? If you're an applicable large employer, then the pay or play provision will apply to you. If you're a small employer, which would mean 100 employees or less, you'll be able to buy on the exchange as a group, and you'll also be governed by the pay or play provisions as an applicable large employer. So for example, if you're a small employer, that means you're both a small employer and an applicable large employer and governed by two different areas of healthcare reform. Okay, so what's an applicable large employer, just to kind of go a little bit deeper into it? An employer that has had an average of at least 50 full-time employees, including full-time equivalents, which we'll talk a little about in a minute as well, during the prior calendar year. So we'll be looking, for example, for calendar year plans that renew in January 2014. You'll be looking at how many employees you had during the calendar year 2013. And that sort of emphasizes the stresses the importance of determining what your healthcare reform strategy is today, because the hours that your employees are working right now will impact 2014 to you. Also, just a quick note, for those employers who are sort of hovering at 50 employees and maybe thought healthcare reform would go away because the Supreme Court would overturn it or the presidential election would change the outcome and aren't really ready for healthcare reform, there is something that we're calling the safe harbor or transition relief. Healthcare reform regulators have issued guidance that says if you're one of those employers hovering at 50 you're allowed to use this transition relief, which allows you to choose to only count employees' hours for 6 months in 2013, 6 consecutive months. And so, for example, you could use April through September, and then based upon that calculation, you would determine if you're an applicable large employer. So it's giving you some time to sort of figure out how you're going to capture this information, calculate it, crunch your numbers, and determine if you're an applicable large employer. And again, if you're an applicable large employer, the pay or play provision under healthcare reform will apply to you. And so let's take a look at one of the examples of how you calculate applicable large employer. For the purposes of this webinar, we're going to try to keep the numbers and the situations relatively easy so that we can all follow along. Your real-life situation is probably going to be more complicated than this, but at least it will give you a feel for what you need to be doing now to plan for 2014. So in the facts of this case, our employer has 40 full-time employees in 2013. So these are employees who are salaried, they're working 40 hours a week, and it's pretty clear they're full-time, and they're 40 employees every month, okay? So again, pretty easy. The next fact here is that the employer also has 30 additional part-time employees that help out during the busy times. So for example, in this example, it's April to August, which is 5 months. During these 5 months, each month, 10 of those employees worked 100 hours, and 20 of those employees worked 120 hours, again, each month, April through August. So we do the math. We take 1,000 hours, which is 10 employees times 100 hours, plus 2,400 hours, which is 20 employees times 120 hours, and that comes into a grand total of 3,400 hours. So that's the additional hours in the year. So we divide 3,400 hours divided by 120 hours, and you ask 120 hours, where did I come up with that? That's just a number within healthcare reform that they tell you to use, that when you're counting these full-time equivalent employees and trying to come and create them into the equivalent of a full employee, you can divide by 120, which is the maximum number of hours. So when you divide 3,400 by 120, you come up with 28.33 full-time equivalent employees for each of those months. Now in healthcare reform math, we don't count decimals at all. So if it were even 0.8, we would drop the decimal. So what I like to think about is, in this case, I have 28.33 full-time equivalent employees, and healthcare reform does not count body parts. So in this example, I would have 28 full-time equivalent employees each month added to my applicable large employer calculation. So again, we'll have a chart here to see if this makes it a little bit more clear. In my full-time column, I added 40 employees for each month, because I made this example, again, simple. For the month of April through August, I added 28.33 into my center column there that says FTE, including seasonal. And then in my column on the far right, I put those two numbers together. And again, it added up to 625.65 employees divided by 12, which is 58.80. Okay, so again, in this example, we've got 51.80. We don't have body parts. So in this situation, this employer, for purposes of healthcare reform, has 51 full-time employees, including their full-time employee equivalent. So while this employer may have thought they had 40 employees for purposes of healthcare reform, and they were not applicable large employer, and the pay or play provision did not apply to them, once you do the healthcare reform math, this employer may be surprised to learn that in reality for 2013, they had 51 employees, and therefore for 2014, they must pay or play. Okay, so looking at another example, taking it a little bit slightly more difficult, we have something under healthcare reform called the seasonal employee exception. And if the seasonal employee exception applies, we'll show you an example of where it does apply, it changes the result. Okay? And the facts in this case, again, keeping it simple, we've got an employer who has 40 full-time employees in 2013. The employer in this case also then has 80 seasonal full-time employees that help out during busy time. In this example, it's September through December, which is 4 months, which is going to be a crucial difference in two examples. Also, this is a good time to mention that healthcare reform has its own dictionary. They haven't published it quite yet, unless you want to consider regulations in the statutory law guidance, but really what we need is like the Webster's Dictionary for healthcare reform. Healthcare reform is using, as you probably already have experienced, a lot of new terms. For example, applicable large employer. That's something I hadn't used before in my vocabulary. It now means something under healthcare reform, and it is very well defined. We also have a new word for us. We also have other words like seasonal employee. That's a word that we've used before in our workplace, in our industry, and under healthcare reform, they use a similar term called seasonal employee, but it means something different. And so you really need to be careful under healthcare reform to make sure that when you're using a term, you understand its meaning. Okay? So in this case, we are going to say again that we have 80 seasonal employees that are working 4 months during the busy season. And so again, breaking this down, we've got the first word to be for, FOR. For 8 months, the employer had 40 full-time employees. For 4 months, for the other 4 months, the employer had 120 employees. So again, breaking down the math. So we take 40 employees times 8 months, which equals 320 employees. And then we take 120 employees times the 4 months, those are the seasonal employees, and we come up with 480. And then we add 320 plus 480 to come up with 800 employees for the year. Then we take 800 employees and we divide it by 12 months, which results in 66.5 employees, again, not counting body parts, so we really have 66 employees. And here's how the seasonal employee exception changes the results. Because the employer's workforce equaled or exceeded 50 full-time employees, counting the seasonal workers, for no more than 4 calendar months, this employer would have less than 50 employees if the seasonal employees were disregarded. So the result is that the employer, in this case, is not an applicable large employer for 2014. So again, I have a chart. Again, in the first column, I've listed 40, right down below for every month. And then in the full-time equivalent seasonal column, for October through December, I added 80. And then in the far right-hand corner, I did the math I just explained to you, which turned out to be 66.5 or 66 employees. But because of the application of the seasonal employee exception, we're going to be looking at that big red circle number for you. And in this case, this employer would truly have 40 employees. Okay. Now, just to point out again, the difference, because you can't see all the slides right away, the difference between example 1 is that those individuals worked 5 months, and so therefore they were included. The example 2, where we used the seasonal employee exception, I intentionally changed the facts to mean 4 months, which then allowed the seasonal employee exception to change the result and keep this employer outside the pay or play provision by having it the result be that only 40 employees truly work for this employer for the 2013 plan year, calendar year. Okay, so now we did the math and we saw sort of how that works. This is the fine print. Seasonal employees. Just a reminder again that seasonal employees who work for an employer for only 120 days, we look at the months, work more than 120 days, they actually are included in the applicable large employer calculation. Okay. Again, the fine print, employees. In order to calculate the applicable large employer status accurately, you need to have your employees classified correctly. So we've all heard of independent contractors. Many of our organizations have them. And we know the importance of classifying individuals correctly. So if you have an employee who you're exerting too much control over, but you're calling them an independent contractor, you know that there are bad things that can happen to you even before healthcare reform came about. Healthcare reform is going to give you one more reason to make sure that that classification is correct. And in this situation, if you're misclassifying employees as independent contractors, there is a greater chance that you will be discovered. And the reason is individuals who are working for you that are deemed independent contractors, if they go onto the exchange and try to purchase coverage with a subsidy based upon their low income, the government is in its best interest to try to determine whether or not that individual is truly working and should be getting benefits through an employer, a true employer. And so they're going to be providing subsidies or premium tax credits. And so it may come into play that they will start to investigate if that individual is truly your employee, because if they change the status, they reduce the spending on the federal side. Okay? So the next area we'll talk about is what we call common ownership. Again, that fine print. We looked at the basic math of adding up how many employees you have, but you've got another issue you need to be aware of, and that's all employees of a control group are taken into employees of a control group are taken into account when determining whether members of a group are an applicable large employer. Okay, so we're going to go over a little bit about common ownership and control groups and how that plays into the healthcare reform world. Before we get started, as Anthony said, I'm an attorney. I'll give you a little disclaimer. Control group ownership and looking at this can get really complicated. And that's why there's attorneys that specialize just in this area and setting up your corporations just the way you want them for control reasons and tax reasons and liability reasons, okay? So again, my disclaimer is that this is very, very basic discussion of control group. Mainly the goal here is to show you the impact of common ownership under the healthcare reform realm. Okay, what we're using here in our examples that are coming in just a moment, we're using a ERISA standard. And so if you are already sponsoring a pension plan and those same rules in the pension plan apply to your health insurance plan. So to the ERISA governs both. So if you know how your plans are being treated for pension, the same is going to hold true for your health plan. And then also consider when you're looking at these control group rules, how are you treating your plans today? Many entities, many companies that we work with, they have two different related companies. They've treated them as one to go to the insurance carrier to get better rates because they've combined their experience and they've got better. The larger you are, the better your rates generally are when you're negotiating with the insurance carrier. And so a lot of employers want to look larger when they go out into the market to purchase coverage. And so keep in mind if you're currently treating two different entities as one when you talk to Anthem or Humana, and now you decide for healthcare reform purposes you want to split them out and pretend that they're not related, that's going to look bad. You can't have it both ways. So keep in mind what you're currently doing today is going to also be a factor in this consideration. And then again, the disclaimers, work with your tax advisor. You're going to see the impact of common ownership. These are very basic examples. In real life, most of the companies that we work with, it's much more complicated than that. And so it's possible that you will have to talk to your tax advisor if you think, if you're one that is not very, very basic and easy to understand, or if you're considering making a structural change. Okay, so on to the example. In this case here, we have a parent subsidy control group, and we're going to look at parent sub, okay? A control group exists when one or more chains of companies are connected through stock ownership with a common parent corp. 80% of the stock of each corporation is owned by one or more corporations in the group. So that's the test, is it 80% or not? The parent company must own 80% of at least one other corporation, so meaning not just itself. Okay, and there's the citations under ERISA for those of you who are adventurous and want to go and look at the exact text of what I'm talking about. So in this example here, we've got Blue Corp as the holding company or the parent company, and they have no employees. Blue Corp owns 90% of Red Corp. Blue Corp owns 80% of Green Corp. And Blue Corp owns 65% of Orange Corp. And so again, we'll just kind of go back over this. The Red Corp has 40 employees, the Green Corp has 60, and the Orange Corp has 45. And so again, the Green Corp did their applicable large employer test. They figured out they had 60 employees. The Red Corp did their calculations we did a little earlier, and they came up with 40. But now we need to determine if any of these need to be joined together for purposes of healthcare reform. So in this example, we determined the Red and the Green Corp are considered commonly owned under the ERISA test for parent sub, and therefore the Green and Red Corp are both applicable large employers. So even though the Red Corp had 40 and they thought that the pay or play wasn't going to apply to them, they are part of Green Corp or commonly owned enough to subject them to the applicable large employer definition and the pay or play provision requirements. So what does this mean for healthcare reform, taking it to the next level? Well, let's take a look at applying the pay or play provision to the situation. Again, both the Red and the Green Corp are each applicable large employers. Although both are applicable large employers and subject to the pay or play provision, the penalties on the back end are assessed on a corp-by-corp basis. Again, we'll just keep breaking this example down. If the Green Corp offers affordable minimum value coverage to all of its benefit-eligible employees, it will avoid the pay-or-play penalty. If the Red Corp then decides to pay, which is to not offer coverage, it will be subject to the pay-or-play penalty. The Red Corp's decision, however, will not impact the Green Corp. Okay? The Red Corp in this situation would pay $2,000 per year times the number of employees it has. However, the pay-or-play provision, if you calculate the penalty for pay, you would usually take number of employees minus your first 30 times $2,000 per year. So again, it's your number of employees minus 30 times $2,000 per year. Now the calculation is done on an annual basis, but for the simplicity of this webinar, we're just going to use the annual numbers. So then you might be asking why I have just 12 employees subtracted in my equation. Well, when you have two different companies like the Green and the Red Corp, they don't each get to subtract 30 employees. So healthcare reform has combined the two entities for purposes of determining applicable large employer status. But then when it comes to the penalty phase, they're going to make them share the 30 hours on a prorated, the 30 employees deduction on a prorated basis. And so in this case, that gives that this Red Corp may only subtract 12 of its employees. And I think we said Red Corp, let's see here, had 40 employees, so that would be 40%, because I made the numbers easy for myself. The Green Corp had 50 employees and the Red Corp 40. So with regard to the 30 employee deduction, I allowed Red Corp to take 40% of the 30 employee deduction, so that would be 12. So in this case, the Red Corp would owe $56,000 to the IRS for paying, which means not offering coverage. And again, as to reiterate, the Green Corp would not be affected by the penalty phase of this at all. So again, that was the brother sister, so the parent sub calculation. The next is the brother sister test. This is companies that are owned side by side versus stacked. Okay. A brother sister control group is a group of 2 or more corporations in which 5 or few common owners own directly or indirectly a controlling interest in each group and have effective control. So again, breaking this down, the brother-sister common ownership test has 2 parts to it. First, controlling interest, which is 80% or more, and the second is effective control, which is 50% of stock or more. Okay, I'm drawing you an example. Adams Corp and Bell Corp are owned by 4 shareholders. To meet the controlling interest test, the same 5 or few common owners must own at least 80% of stock of some interest in all members of the control group. In this example, the 4 shareholders together own 80% or more of the stock in each corporation. The ownership test is met since the shareholders own 100% of the stock. So in our example under Adams Corp, April owns 80 and 20 under Bell. Bob owns 10 under Adams, but then 50 under Bell. Carol owns 5 under Adams and 15 under Bell. And Don owns 5 under Adams and 15 under Bell. And then when you add those, both columns up there, they each total 100%, and therefore the controlling interest is 80%, and that has been met because it's 100%, which obviously is higher. So that's the first part of a 2-part brother-sister test. So let's look at the effective control test for brother-sister corporation. Again, Adams Corp and Bell Corp are owned by the same 4 shareholders, but to meet the effective control test, the same 5 or fewer common owners must own more than 50% of each corporation, taking into account the stock ownership of each person, but only to the extent that such stock ownership is identical with respect to each corporation. Okay, we've got an example coming, so hang on. In this example, although 4 of the shareholders together own 80% or more of the stock of each corporation, they do not own more than 50% of the stock when you look at the identical requirement. And so we'll show you, we'll just kind of run this for you. So April, with regard to effective control, she owns 80 and 20, 80% of Adams and 20 of Bell. So we're going to cross off the 80, and that to make it identical, we're going to change the 80 to 20, which is the result in the right-hand column there for you. And so Bob, he's got 10 and 50. And again, looking only at identicalness, that turns into 10. So in the far right corner, we're taking out the 50, and basically I'm taking the 50 for Bob under the Bell Corp and making that a 10%, and that result is in the right-hand column again. And then for Carol, again, the red check box is showing up for you. Carol, for identical ownership, she's got 5%. And the same result for Don. When you look at identical ownership, it's 5%. So in this case, the effective control test is not met because it has to be 50%, and in this case, it's only 40%. And so what does that mean? That means that the Adam Corp and Bell Corp, although brother-sister companies, and although they had 80% controlling interest, the effective control test at 40% was not met. So these entities are not together looked, they're not pulled together, and therefore they're not an applicable large employer. And so the pay-or-play provision does not apply to them. So again, the Adams Corp and Bell Corp met the 80% controlling interest test. However, because they did not meet the 50% effective control test, they are not commonly held, and each entity will count its employees for purposes of applicable large employer test independently. Okay, so they won't be brought together. So again, just kind of as a disclaimer, this is just showing you, the goal is to show you how common ownership will change your results in the healthcare reform arena. There's also some rules that we're, for sake of time, we're not going to get into too deeply. There's also a rule regarding affiliated service groups, and there's also some rules about family ownership. So if, for example, in those cases, Bob and April were brother and sister, that might change things. And those rules get even more complicated than what we're talking about today. So again, stressing the importance of working with a tax advisor or a corporate attorney if you think you have a problem. If your situation is more straightforward, then you're good to go. But again, that was just sort of just an introduction to show you the importance of making sure you do that analysis when you're talking about your healthcare reform compliance. So the next category we're going to talk about is benefit eligibility. Our first main topic was applicable large employer. So how big is your organization? And we measured that. And based upon that, we determined if you were applicable large employer, and if so, the pay or play penalty is applied to you. The benefit eligibility test is a second bucket of things that you need to do under healthcare reform. And again, it has its own healthcare reform math, okay? So we'll start with the easy part, full-time employees. Healthcare reform defines a full-time employee as those who work an average of 30 hours per week or 130 hours per month. So definition of new full-time employee. If a new employee is reasonably expected at his start date to work full-time, the employee may not be required to serve a waiting period in excess of 90 days. And now, so how do you know if someone's going to work 30 hours or more per week? Sometimes you don't know, right? Well, with a new full-time employee, you look at the reasonable facts and circumstances. You look at, for example, did that person replace a person who was working 40 hours per week on a regular basis? If so, then you might want to treat them as being a new full-time employee right off the bat. If everybody else in that job category is full-time and this employee is coming in new, again, that might lean toward it being a new full-time employee. And so then the 90-day waiting period limitation will apply. Okay? And then next we have something that healthcare reform has created as a definition that's called ongoing variable employees. And this means people who have been working for you for a while, but their hours are variable. So sometimes they'll wonder if they're working more than 30 hours or less for purposes of benefit eligibility. And so healthcare reform is giving you a standard or math to figure out about these ongoing variable hour employees if they're benefit eligible. Okay? And so again, some more new terms for you. We have what we call the standard measurement period, which could be anywhere between 3 and 12 months long. And that will be the period that we sort of look at hours worked by each variable hour employee and do some averaging to figure out if on average they work 30 or more hours per week during that measurement period, and then that will make them benefit eligible for the stability period. The stability period must last at least 6 months, but also at least as long as the measurement period. So for example, if you use a 12-month measurement period, This stability period also has to be 12 months. Okay? So again, the measurement period is when you crunch all the numbers and you figure out how much people have worked and if they qualify then for benefits based upon their past performance. And then they're locked into benefits during the stability period, regardless of the hours they're working in the stability period, because they're sort of, locked in and they've earned it for the stability period. And then last but not least, another term for you there is the administration period. And we'll show you some examples in just a moment, but the maximum for administration period can be 90 days. And also note, it'll make sense when you see the chart on the next slide, also note the administration period for ongoing variable employees can never create a gap in coverage or the sort of timeout in counting hours or a stability period. So the administration period is always going to run on top of another stability or measurement period. So let's just show you a picture of what this sort of looks like. This is an example of a 12-month stability period and a 12-month measurement period. This is what many employers will be doing at the end of 2013. If they're a calendar year plan, for example. You'll be going, and this is just an example, but in this example, you come October, you'd be taking all the hours that people worked from October 15, 2012, all the way through October 14, 2013. You'd run all the numbers that your variable hour ongoing employees are working, and you'd use October through December to sort of crunch the numbers, figure out who's earned benefit eligibility, and then going into January 1, 2014, those individuals, if they work 30 hours or more on average, will be eligible for during the stability period for benefits. Okay, so this is what calendar year plans who choose to use a 12-month measurement period, 12-month stability period, will be looking at. Okay, so then year 2, you'll notice that the measurement period, so we're going to assume here in this case that you're in October 2014 and you're going through that same exercise using a 12-month measurement period, 12-month stability period, and you're re-crunching the numbers to determine who you'll be offering benefits for in 2015. Okay? So again, the administration period is going to be from October to December, but our measurement period, our measurement period is from October through December, but again, we're measuring October 2013 to October 2014. Okay, so again, this is the measurement picture for what it looks like when you're figuring out the ongoing employees have been working for you for a while that have variable hours. Okay. So then we have new variable hour employees. So this is a little bit more difficult because in my example, I'm only hiring one employee in the year, but most organizations probably will have a little bit more than that going on. So let's just take a look at how you measure benefit eligibility for your new variable hour employees that you're hiring under healthcare reform. The initial measurement period can be 3 to 12 months. The stability period has to be the same for ongoing employees. The administrative period can be, again, no more than 90 days. Now, IRS guidance is explaining that when you add all these numbers up, there's still a maximum that you can only take about slightly more than 13 months, so in other words, not 14 months, just a little bit under 14 months, to determine whether variable hour employees are eligible for benefits and then also get some coverage. Okay, here's a little practice tip. And in general, when you're looking at healthcare reform and what it says you can and can't do, keep in mind that sometimes healthcare reform may give you a choice. Like, for example, in the measurement period, we talked about one of the choices is you can measure hours every 3 months. And then you have a stability period of, probably 3 months. That's an option under healthcare reform, but it probably doesn't fit most employer situations very well because you'd be crunching numbers 4 times a year, enrolling employees 4 times a year, and disenrolling employees in your plan 4 times a year based upon their hours. And so just because healthcare reform gives you a choice doesn't mean that every choice is a good choice for you. So that's where you need a good advisor to help you figure that out. So in this area, the practice tip is, keep in mind that employers cannot use a 12-month measurement period and have a 90-day administration period for a new variable hour employee. It doesn't work because the 12 months plus the 3 more months would exceed more than the slightly more than 13-month rule. So although you've got some options there, keep in mind that you still have to meet the overall criteria that new employees, you've got to figure out whether or not they're working on average of more than 30 hours per week, just a little over 13 months. So that's how long you have to figure it out. So in some cases, for example, if you're using a 12-month measurement period, then that means your admin period is going to have to be a little bit shorter. So you have to do your number crunching a little bit faster to make sure that you get it done in a little bit less than 13 months. Okay, so let's look at a picture just to see if that makes this a little bit more clear. Okay, in our example here, we hired a new employee. Okay, so we did our number crunching in the first screen there. We had the variable on ongoing employees that have been working for us forever, but their hours are always fluctuating. Okay, in this case, we hired a new employee on October 10th, 2014. So you see that on the first line there. And that little blue grade shaded area is going to be the administration period. And I'm going to start counting her hours on June 1st because it just makes my life easier. So I can split up my administration period if I want to make things a little bit easier for me to calculate. That does work, so long as it doesn't exceed a little less than 13 months. Okay, so for 2015, you're looking, so she was hired October 10th. So I'm going to look at how many hours she worked from June 1st, 2014, and stop counting April 30th, 2015. So in this case, my measurement period is really only 11 months, but I'm doing that on purpose. I want to allow myself a little bit more time to do the number crunching and figure things out to determine if she's eligible for benefits beginning July 1st, 2015. Now in this example, I'm going to pretend that she worked enough hours, and she, during the measurement period, which would be 30 hours or more, and so it's during the stability period, which is July 1st, 2015 through June 30th, 2016, the last row there, she's going to be eligible for coverage during the stability period, regardless of how many hours she works. So let's again say for the measurement period, she's working average of 35 hours a week. For some reason in the stability period, after she's gotten brought into the benefit plan, her hours are dropping. Maybe I don't need her as often or she's not available. It doesn't matter. As long as she remains an employee, during the whole green area there, she remains benefit eligible, and I am required to contribute to my portion of the cost of her premium so long as she's an employee during that time. Okay. So let's go crazy here and put those two pictures together. Okay. So we've got the standard measurement period, which is what we use for ongoing employees, and the initial measurement period, which is what we use for new variable hour employees, and we put it together. So let's see, to start from the beginning here. Let's look at October 15th, 2014. That's my measurement period for my ongoing employees. My administration period is October 14th, 2015. Again, I'm in the second row in that gray shaded area. And then my green on the third row is my variable hour ongoing employees. And I'm going to calculate that again in a 12-month measurement, 12-month stability period. But the good news is when this person got hired and I did her initial measurement period, she qualified for benefits. Now let's just go back one screen. She qualified for benefits through 6/30/2016. But when I'm doing this calculation here, I also have to include her in my numbers as well. So she still sort of gets what I call 2 bites at the apple, because her eligibility on the bottom row here, her eligibility based upon the initial measurement period could end 6/30/2016. But now that I'm going back and measuring my ongoing employees, she's also an employee in the ongoing bucket, and I need to also include her there too. So based upon this calculation, I need to figure out if 1/6/30/2016 occurs, does she qualify based upon the measurement period of October 15, 2014 through October 14, 2015? Does she also qualify for benefits all the way through over here, you can see on that, over there, all the way through December 31st, 2016. So you're going to be using a measurement period and a measurement map for your ongoing variable employees. And you're going to be doing that based upon their start dates, okay, to figure out if they're qualified, because you don't get to just wait forever to put them on the plan if they're working enough hours. You're also then, when you're doing the ongoing variable measurement period, you're going to include her again in these figures. Okay, so she's going to be included in both calculations. Okay, so your homework for 2013. Determine if you're an applicable large employer. It seems easy enough, but as you saw when we went through the scenarios, it can get a little complicated for some employers. You want to watch that common ownership issue, and you want to really watch your employees and make sure you define them appropriately so that you get the right results. Okay? Second, you want to determine who's benefit eligible. Again, make a decision on measurement stability administration period. Again, we talked about you have a choice between 3 and 12 months, but you want to pick the right one for your organization depending upon your turnover. If you're doing 12 months, that makes sense for some employers. Some employers, maybe 6 months is a little bit better. What you might want to do now is run the numbers now. Go run the numbers for 6 months for 2012, July 1st through December 31st, and what does that look like? And what does that make you an applicable large employer? How many people are going to be benefit eligible? Don't wait until renewal to try to figure this out. Start doing it now. And then also by looking at it now, you can manage people's hours of service. And so that if you have someone who's just barely working, say you don't provide benefits until someone's working 35 hours in your self-funded health plan, maybe you realize you don't want that person working 35 hours. You want them working 29 or 28 because you don't want to provide benefits to them. So those are some things you can be managing to now to prepare for 2014. Then have a discussion with your payroll person, your vendor. You saw all these numbers that we're running. Someone has to get you that information so that you can crunch the numbers and run the numbers to figure out who's benefit eligible. Your payroll person may not be talking to your benefit person, so you need to let payroll know, hey, by the way, come October, I'm going to be asking for all this information. Can you capture that for me, and how can we capture it? Does our payroll system do that now, or do we need to change something? And then here, one more homework assignment for you is discuss with your employee benefits advisor transitional relief that was released in January of this year, especially if you're non-calendar year plan. So for example, if you're renewing in July or in June for 2013, what you need to understand is that the pay-or-play provision goes into effect January 1, 2014, and it doesn't matter when your plan renews. So if you're not healthcare reform compliant January 1, 2014, you will be paying penalties. There is some transitional relief. You need to be looking at it now to see if you qualify. If you qualify, what it means for you is when you renew, for example, in July 2013, you can make some benefit decisions based upon the fact that you know come January 1, 2014, your penalty will either be non-existent or at least reduced until you get to your July 2014 renewal and you decide to do full healthcare reform compliance. But again, you can't wait till 2014 to do that. You need to start doing that now. And then last but not least, I guess the good and the bad news is be prepared for more guidance. One of the most frustrating parts about my job is I have a lot of questions I'm getting asked, and I don't have the answers, not because they exist or I can't find them in the materials we have, but because we're waiting for more guidance. And so we're expecting a lot more guidance, and so stay tuned, watch our H&I University schedule, and make sure that you are aware of all the different guidance and how things are going to be changing as 2013 develops. And so again, just sort of recapping, you saw the healthcare reform series that we're doing. Please visit that and make sure that you stay signed up for things that are of interest to you. And then also I'm going to move the discussion stage now, and I'm going to pull and take a look at some questions and see how many we've got. Just take me a minute here to open the slide. Okay, we've got just quite a few questions here. We'll just start from the top and we'll get through as many as we can. Okay. Yes, we have a question here. The question is, will we be getting copies of the slides? And the answer is yes. In the chat window, I did include a URL link that you can go to print them out. We also will be uploading in the next day or so a copy of the slides and also a recording of this presentation. So if you know someone that missed it or you want to listen to it again because this is a lot of information, maybe hearing it a second time is going to help you. If you go to hni.com, under HNI University, you will find a link to, again, the slides and the recording of our presentation. Okay. And we have a little bit longer another question. Let's see. I have a question here. As I came to this webinar late, does this deal with small businesses too? Yes. Healthcare reform, I guess part of what our presentation tried to cover is, are you a small business? And as the healthcare reform defines it, are you under 50 employees, and therefore healthcare reform will not require you to pay or play? So yes, we do. Our presentation is, I think, applicable to most size businesses, especially trying to figure out where it is that you fall in the healthcare reform requirements. Let's see, we have a question here. Are seasonal employees the same as temporary employees employed during a seasonal period but paid by a temp agency? And again, for just me and the audience, are seasonal employees the same as temporary employees employed during a seasonal period but paid by the temp agency? That's a great question. If in this situation, I would define, for purposes of healthcare reform, that these individuals are probably not your employees. You're bringing them out to the temp agency, so you're not paying W-2 wages. They come and go through the temp agency, so you have they're not. So in this case, I would say no, they're not. Yes, I see how this is kind of how healthcare reform and the terms they use make things a little bit confusing. To you, they may be seasonal employees, but for healthcare reform purposes, they're temporary individuals that happen to perform services for you, but they're not your employees, again, because of W-2 status, and so they would not calculate into the applicable large employer tax. We've got some duplicate questions, so I'm just deleting them here. Next question, if you have over 50 full-time employees, do you have to do these calculations? If you do you have to send them in somewhere to prove that you are 50 full-time employees? If you're well into the hundreds, no, you don't need to go through this analysis to determine applicable large employer status. So remember, we talked about, in our first portion, we talked about the mathematics of how large are you. But then, so if you're well over that and you don't have any common ownership, which one of the examples I gave you is, let's just say you're an employer and you have 100 employees, but you have a commonly owned entity that has 20. When you don't necessarily do the math that you think you might be doing, but you need to look at your common ownership to see if that other entity that's 20 becomes part of your bigger entity. So you still need to look at applicable large employer. You just probably want to do the monthly employee calculation test and then divide everything else by 12. Okay. Just looking for some questions here. Another great question, how do the hour requirements translate to truckers working per mile? About 2 weeks ago, we did a healthcare reform roadmap for transportation industry presentation. If the person who's asking that question also wants to make sure that that recording is available for review. But to answer your question, unfortunately, we do not have guidance on how drivers who are paid by the mile, how their time put in for the employer or service performed translates into hours. We do know that the regulations that came out in early January talk about airline pilots and how their hours are regulated by federal safety guidelines so that they can't work too many hours. And so there is some addressing, I guess, of the issue that some industries do not pay their employees by the hour. They pay them by the mile, or they have limits on how many hours they can work. And so the comment section closed on those regulations I think on March 13th they'll be closing. But so we'll be waiting for guidance in this area. So unfortunately, we don't have any clear answers. What I'm recommending that our clients do at this point is, if you're worried about truck drivers who may not be benefit eligible now, but depending on what the guidance looks like, may be newly eligible for benefits in 2014, what you can be doing is looking at, why don't they have benefits for you now? Are they getting it elsewhere? Are they getting Social Security benefits? Where do you think they're getting their coverage? Because if you were to have to offer benefits to them, how do you think that they would respond? And in the meantime, we'll just wait for guidance. I will share this comment with you. Someone asked, I think jokingly, could you make this more complicated? The answer to that very good statement is, my job is unfortunately just to tell you what healthcare reform says. It is very complicated. Some of the rules don't make sense. Sometimes people come to me and say, well, but what about this? And it doesn't make sense, and I keep reminding people that it's healthcare reform. It doesn't have to make common sense. So good point. This is a little confusing. The good point is that the recording will be available to you if you want to listen to it again, or that you can contact your HCR representative if you would like to have a more in-depth discussion about how healthcare reform applies specifically to your situation. And we have another question here. We are a contractor employer, over 50 full-time union employees that are covered by a collective bargaining agreement for which we pay into the health fund. The insurance is provided by the union. We only have 16 employees for which we provide insurance for. Are we considered a large employer? This is a great question. We have a client of ours. We have a client who has a lot of employees, and a lot of them are union. So the union benefits, the union providing benefits to those union employees, and then they have 16 office employees. So when you do your calculation for applicable large employer, you would be an applicable large employer, because although those individuals are union members, you still issue W-2 wages to them, you still control their work, and they are your employees. So although they're getting coverage elsewhere, you are an applicable large employer and subject to the pay or play provision. Sorry for that bad news. Okay. Let's see. Is the process of measurement, periods, etc., required simply to determine potential penalty amounts, meaning only large employers need to do it? Let's take a look at that. Is the process of measurement period required simply to determine potential penalty amounts? That's a really good question. When we talked about the measurement periods, and we looked back 12 months, we went forward 12 months. That whole process applies to only applicable large employers, but it applies to them even if they're going to pay or play. And so if you're going to play, which means offer coverage under healthcare reform rules, you need to know who's going to be benefit eligible, and healthcare reform is going to tell you how that's determined. If you decide that you're going to just simply pay the penalty and walk away, you still would need to do, unfortunately, the measurement stability period, because that number we're coming up with, how many employees are eligible for coverage in 2014, for example, that's the number you're going to use to subtract from 30 and multiply by 2,000. So again, that measurement stability period only applies to applicable large employers, but it applies to both those who pay or play, because either you're determining who to offer coverage to or how much your penalty is going to be. Let's see. If we talk about grandfathering, that's a great question. And again, healthcare reform is this huge piece of legislation. We're breaking things out into chunks to sort of, hopefully chunks that sort of make sense that everything goes together. Grandfathering is a little outside this discussion. What I will just answer for you is, under healthcare reform, when healthcare reform first came about, President Obama had made a promise that if you like your health plan now, you will get to keep it. And so grandfathering was a provision that was intended to honor that promise. If you're a grandfathered plan, it meant that you, since the beginning of healthcare reform, agreed to make very minimal changes to your plan and comply with just a few of healthcare reform's requirements. But you needed to follow that plan consistently, so you couldn't change your mind and go back. If your plan is grandfathered, it would be disclaimed on all your enrollment materials, your employee booklet that go to your employees that describe the benefits. So you should know if your plan is grandfathered or not. If you've lost grandfather status, you can't go back. If you need a more detailed discussion of the grandfather plan requirements, and if you happen to keep your grandfather plan status, that would be something we could do offline. If you just contact HNI, either myself or one of your HNI representatives that you're working with, we can go through that analysis with you. Are there any differences for nonprofits? At this time, again, we're waiting for a lot of guidance. At this time, my understanding is that nonprofits are governed by healthcare reform the same as other units. Okay. Next question. Do you need to count employees who are covered under another health plan or waive coverage? This is again, I keep saying this, these are all really great questions, because these are things that we get asked by our clients all the time. So again, do you need to count employees who are covered under another health plan or way of coverage? And the question is, count how? Again, this is called healthcare reform math. So let's kind of go through this in stages. Applicable large employer. How big are you? We need to know how big you are to determine if you're governed by the pay or play provision. So with regard to that counting of employees, yes, you count all employees that work for you. And we even count targeted employees, remember, for full-time equivalent status. Doesn't matter what they get the coverage. Do you have 50 or more employees? And if so, you're an applicable large employer. So yes, in that situation, you count people regardless if they have benefits with you. Then number two, the measurement period, those charts with the nice pretty colors that we had with the measurement stability period. Again, when you're counting who's benefit eligible for you in that stage of healthcare reform math, yes, again, you count individuals that have coverage elsewhere because you need to determine if they're benefit eligible going forward for two reasons. If you're going to pay the IRS, that number you come up with is going to include even people who are waiving coverage because you still fail to provide coverage through, or at least an option of coverage through your employer's employment relationship. On the other hand, even though they're getting coverage elsewhere, when you're doing a measurement stability period, you need to determine if you're going to be offering them an opportunity to get in your plan for next year because they could always change their mind. So again, do you count those employees? Yes, you count them for a couple of reasons. Applicable large employer application, as well as who's benefit eligible. And I think we're almost out of time, but I will just stay on line with a few more questions. Is there a definition of hours worked? Are benefits hours of leave and are benefit hours and leave hours that may be unpaid included? Again, healthcare reform in its own dictionary. Hours of service. It's a term that it's used for how many hours did that employee work during the measurement period to determine benefit eligibility. Hours of service is one of those unique terms that's used elsewhere in the world. For healthcare reform, it means something else. Hours of service, to clarify, it includes not just hours worked where you're paid for your services, but it includes paid time off for holidays, vacation, sick time, and disability. So any payments that you're giving people, even for those reasons, are going to be calculated into the number of hours of service to qualify for benefit eligibility. Does the old benefit waiting period equal the new admin period? Are these new periods for calculation only, not for the real function of the plan? The question is about the measurement period, stability period. And yes, when you choose your stability and your measurement period, the example that I used was 12-month measurement, 12-month stability with your admin period happening in fall. If you're a calendar year plan and you decide to use that measurement, that stability period, that will mean that your renewal, if you're fully insured, will still be January 1 renewal date. And so that seems attractive to me. I'm not an employer and I don't have to go through that process with you, but for enrollment purposes, it will feel the same. It will look the same for employees. They will always do enrollment in fall if that's what they're used to. So yes, if you choose a stability period and a measurement period, that is when your enrollment is going to take place. So for example, if you choose a 6-month stability period and a 6-month measurement period, that means twice a year you're having enrollment into your plan. And twice a year you're having disenrollment into your plan. So if someone only qualifies for benefits for the 6-month measurement period and you recrunch your numbers, it's possible they'll drop off your plan in the next 6 months. So if you pick 6 months measurement stability, you'll be having two enrollment periods per calendar year. Another great question, are owners of companies exempt from the employee count? I'll give you the quick answer. Again, this is something we talked about in more detail in the presentation about 2 weeks ago on Healthcare Reform Roadmap for Transportation Industry. There are certain employees that are working, certain individuals that are performing services to you that are not counted, and they're called excluded employees. One example is employees in the subchapter S. If they own 2% or more, they are not eligible. They don't count for the applicable large employer calculation. Okay. And then someone's asking for more information on the common ownership with regard to family relationships, and that would take probably about 30 minutes. So again, you can contact H&I and we can give you some materials that we have that sort of explain that to you. Basically, the family ownership issue is that when you have a brother or sister or your children owning into your company, it's possible that they can be looked at together as being one owner, one individual. So, for example, you can't, if you have two companies and you want to give some of the ownership to one of your siblings or one of your children to try to avoid health care reform, it's probably not going to work. That's the short answer to a very long question. Last question here. Do qualifying events count during stability periods? So eligible, didn't initially enroll, but experienced a qualifying event during stability period. Again, great questions. There's so many great questions. Yes, if you have a measurement period and you calculate that Renee is eligible for coverage for 2014, but Renee declines in January during enrollment period because I'm on my husband's plan, and for example, Renee and Bruce get divorced, and it's effective in July 2014, that would still be a special enrollment period under HIPAA and Section 125 rules. And so I would be, because I qualified for benefits in 2013, I worked enough hours, I just did a valid waiver in January 2014, and then had a qualifying event in July 2014. So I get to come back to H&I and say, you determined me benefit eligible. I said I didn't need it at the time, but I need to re-enroll now because of my qualifying change. Okay, and so that is concluding our presentation. Thank you for your time. Again, there's so much to learn about healthcare reform, so feel free to sign up for other presentations on H&IU. Also want to take a moment again to, if I can get my slide to advance, just to thank our sponsors. The reason why we can bring all this resources to you is through the support of a lot of our partners in the industry. And again, I want to say thank you to them, because this is being brought to you in cooperation with H&I and all these different sponsors that are supporting the cost of doing all this for you. So also you'll be getting a short survey sent to you. Please share your feedback. Let us know what kinds of topics you want to hear about. Let us know how we're doing, because as you know, we're doing a lot of these, and if there's some adjustments we can be making along the way, we would like to hear back from you as well. So thanks again for your time, and have a great healthcare reform.